Hey, I'm Buddy McNeese, president of Frederica Wealth Advisory. I've been a financial advisor for over 30 years, and I work right here on beautiful St. Simon's Island. Today, I'm going to be discussing Roth IRA versus a traditional IRA using the 2026 rules. So Roth IRAs are powerful, and traditional IRAs are also powerful, but they're not interchangeable. Most online advice oversimplifies this decision. Today, we're walking through the actual rules, the real math, and what changes once you turn 50. The 2026 contribution limits are $7,500 per person, including an $1,100 catch-up for those 50 and older. And we're investing the tax savings properly so we have a true apples to apples comparison. Let's look at the rules. A traditional IRA, your base contribution limit for 2026 is $7,500, and contributions may be deductible depending on your income and your workplace coverage. Your growth is tax deferred, and withdrawals are taxed as ordinary income. Before age 59 and a half, with exceptions, you'd pay a 10% penalty for your withdrawals. Required minimum distributions begin in your 70s, and it's usually 73 or 74. It depends on a few factors. Roth IRAs, however, contributions are tax-free, growth is tax-free, and your qualified withdrawals are also tax-free. There are no lifetime required minimum distributions, and contributions, not earnings, can be withdrawn anytime. Income phase-outs apply. In other words, if you make too much money, you probably can't do it. At age 50 plus, you have $7,500 base contribution and an $1,100 catch-up contribution for a total of $8,600 contributions. Let's look at the income phase-outs and deductibility rules. Roth IRAs have income phase-outs. Roth contributions phase out at higher income levels. Many married couples filing jointly phase out in the mid 200,000 range. We have to verify that annually. And above the upper threshold, direct Roth contributions are just not allowed. Traditional IRA deductibility, active participation rules, meaning if you or your spouse participate in a workplace retirement plan, such as a 401k, a 403b, a SEP, or your TSP, the deductibility of the traditional IRA contributions may phase out based on income. 3 common scenarios. Number 1, neither spouse participates in a workplace plan. Generally, contributions are deductible regardless of income in this scenario. Scenario number 2, one spouse participates. In this case, the participating spouse faces lower income thresholds for deductibility, and the non-participating spouse often has higher limits. Scenario 3, both spouses participate. In this case, deductibility phases out pretty quickly at higher income levels, and many high-income earners end up making non-deductible IRA contributions. For a spousal IRA, if one spouse has little to no earned income, the working spouse can fund an IRA for both spouses as long as the total income supports it. Phase-out and deductibility rules still apply at the household level. Here's a key point. Before choosing Roth or traditional, determine eligibility and deductibility first. Let's look at some math. Here's an example of an age 30 investor. They have about a 35-year tax horizon, and their current tax rate is 22%. The retirement tax rate is expected to be 24%. They're making a $7,500 per year contribution, and we're just assuming a 7% return. No guarantees, just assuming for this sample. So a Roth, you're making $7,500 annually for 35 years at 7%. Simple math, your future value is $1,036,000, and that would be tax-free. On the other hand, let's look at a traditional IRA with the tax savings invested. So you're making the $7,500 contribution, you're saving 22% in taxes, so that's $1,650 a year. So like the Roth, your traditional grows to $1,036,000, but at retirement, you'd pay taxes at 24%. So that'd be about $249,000 in taxes. So your after-tax IRA value is $787,000. Your taxable brokerage account, this is where you're investing the tax savings. So remember, we've saved $1,650 a year by doing a traditional IRA. We're going to invest that at 7% for 35 years. You'd end up with $228,000. After capital gains, roughly would be $202,500. Let's add that to the IRA, and your total traditional after tax would be $989,500. And remember, the Roth, we would have had $1,036,000. So Roth wins by traditionally $45,000 in this scenario. All right, let's move it up a little bit. Age 50 with catch up. So you're age 50, you have a 15-year investment horizon. Current tax rate's 35% because you're making some good money. Your retirement tax rate is expected to be lower at 22%. The contribution you can make is $7,500 plus the $1,100 a year catch up. So that's $8,600 a year. And we're assuming a 7% growth rate again. Your Roth at $8,600 annually for 15 years at 7%, your future value is $217,000 tax free. So traditional IRA, and we're investing the tax savings, remember. So the annual tax savings is 35% of $8,600 contribution. So that's $3,010 a year that we're saving. The traditional IRA grows to $217,000. And you've got to pay taxes at 22%. So that's $47,700. So your after-tax IRA is $169,300. But remember, we've invested the tax savings in a brokerage account. So $3,010 annually for 15 years at 7% is $76,000. After capital gains, that'd be roughly $71,400. So your traditional IRA after tax with adding to the brokerage account is $240,700. So in this case, the traditional IRA wins by $23,000. Here are some planning considerations. RMDs, required minimum distributions. Traditional IRAs require these later in life, usually around age 73, 74, and potentially this can increase your taxable income, your Medicare premiums, and your Social Security taxation. Roth IRAs don't have RMDs. Here's a gap year strategy. Retiring at age 72, delay your Social Security to age 70, and this creates a lower income year where traditional withdrawals may be taxed at 12 to 15% effective tax rates. This enhances your tax arbitrage. For estate planning purposes, Roth IRAs transfer tax-free to heirs. Of course, they're subject to the distribution rules, but traditional IRAs pass along taxable income to beneficiaries. In this case, the Roth really looks good. The behavioral reality is we're assuming that the tax savings are invested. If savings are spent, the Roth often wins in practice due to the built-in discipline. However, you might use those savings to pay down loans or for any other reason. So you have to look at it on a case by case. Really, in the end, the final analysis is if tax rates are equal and tax savings are invested, Roth and traditional outcomes are pretty similar. If tax rates rise later, the Roth wins. If tax rates fall later, the traditional wins. The objective here is not to avoid taxes entirely, but to just minimize lifetime taxes strategically. And the strongest retirement plan actually uses both Roth and traditional. It's nice to have a couple of different buckets from which to pull money. Thank you so much for sitting through this. And if you have any further questions, please get in touch with us. Thank you.